Non-US investors have about $74.5 trillion under management. This is more the institutional crowd. If they increase their hedge ratios by 5% and reduce US dollar exposure, that could lead to additional selling of about $2 trillion of US dollars, which is quite staggering. And now what we're seeing is the market is typically driven by tactical investors who travel much shorter term time horizon. But people like pension funds and institutional fund managers, they have a longer time horizon, months and years. And so when they take and maybe increase their hedge ratios, that'll happen gradually, a slow burn over a period of time. And so we're likely to see the US dollar weaken. At least that's one more. For the second half, but also we're expecting weakness into 2026.
I want to make a point here. You know, a lot of people are saying, look, it's happening only because of hedging. But I mean, hedging still involves selling in the spot market, right? Give us a sense, though. I mean, historically, what have hedges averaged? Anywhere from what, a quarter to maybe 50%? And how high have they jumped now?
It's very difficult to put the number because all the investors are looking at it very differently. If you're a Japanese investor, you're looking at it very different if you're a European investor or an Australian investor. But what we've seen over the last decade or so has been those hedge ratios have been abating. So fewer portfolio managers have been hedging that exposure. And the reason it really matters is when you do a multi-asset portfolio, your risk premium from FX is normally very, very little, and it's not necessarily a risk that's rewarded. And so in an environment where the dollar's already beginning to weaken, portfolio managers and risk managers will be assessing to see whether, look, if I'm not getting compensated for taking on this US dollar FX risk relative to my base currency, why am I holding that risk if I'm not compensated? And so they'll be reducing. And we're expecting that hedging flow to be incremental to some of the other factors that may be driving the dollar lower, including our view on lower interest rates in the US if the Fed do cut as we anticipate, and also the market's pricing in as well.
3 cuts from the Fed this year, 3 next year, correct? What about the impact of what is likely to happen in the Senate on long yields? And I'm thinking here more what Treasury Secretary Scott Bessent is going to have to do, or likely going to have to do, in the second half of the year, which is continue issuing treasuries, right, at record pace, and potentially pushing out a lot of the issuance. He's got to term it out, right, to the right-hand side of the curve. Will that affect long yields?
Likely to have an impact, obviously, depending on demand and supply. And the point earlier that we made is where will the marginal buy of treasuries come from as they expand this fiscal policy? And they'll do that by issuing debt. And so I think one of the really interesting things is the bank deregulation data that we saw, and Peter also cited earlier, that will allow the banks who are highly regulated in the US, the big banks, to actually warehouse far more treasuries than they do today.
Is this SLR?
This is, yes. So we'll be able to see some of the marginal buying of treasuries from that cohort. We'll see who else will be buying, but I think it will come down to that supply and demand equation. Whereas who are buying the additional treasuries, and for what reason?